Welcome to the Deep Dive. Today, we are peering inside the trading reports of two of the sharpest financial institutions out there.
We're talking about Israel Englander's Millennium Management and David Shaw's D.E. Shaw & Co.
And these aren't just, big hedge funds. They are known for being incredibly data-driven.
That's right. And what they did in the third quarter of this year was, well, it was an almost perfectly coordinated and, frankly, very unusual market pivot.
It really was. The move was like a fascinating binary switch. They aggressively sold out of a celebrated, high-flying AI stock.
And at the same time, they started buying into a financial technology company, one that's, deep in the crypto infrastructure space.
So we're talking about them slashing their holdings in Palantir Technologies. The ticker is PLTR.
And then moving that capital into Circle Internet Group, which is the company behind the stablecoin USDC.
The immediate puzzle here is it's profound. I mean, if
Oh,
you're
yeah.
following the financial news, why would you run from an AI company that's just crushing its earnings?
Yeah, a company that seems poised to just dominate the next generation of enterprise software.
And then you move into what many people still consider the pretty choppy waters of fintech and crypto.
It looks totally irrational.
Right.
Unless you look past the headlines and really, really dig into the financials. And our mission today is to do just that.
Okay.
We want to unpack the core valuation risks of Palantir and then the massive, I think, underappreciated growth opportunity that's embedded in Circle.
To really understand the logic of these financial whales, were they just de-risking or were they getting in on the ground floor of something huge?
Let's find out.
Let's start with the sell side of this story. The reason these funds seem to be fleeing from Palantir, this wasn't a small adjustment, was it?
No, not at all. This was a signal fire. Millennium Management offloaded 4.6 million shares.
Which reduced their stake by a staggering 91%.
91%. I mean, they effectively got out completely.
And D.E. Shaw & Co. did something similar.
Yep. They sold 6.4 million shares, which was a 41% reduction for them. When funds like these, funds known for their meticulous research, make cuts that big,
It tells you something.
it suggests they found let's call it an existential problem with the company's risk profile relative to its price. It's not about the business quality.
So to really get our heads around this decision, let's just briefly explain what Palantir does.
Okay. So their software helps huge organizations, think governments, massive corporations, integrate all their chaotic data into one single unified map.
Which they call an ontology.
Right. It basically creates a real-time digital twin of the organization so they can make much better, much faster decisions.
It's incredibly sophisticated stuff.
It is. But the real reason for the recent boom, the reason the stock has captivated everyone, is their AI platform.
That's the key.
It acts as an orchestration tool, so clients can just seamlessly integrate large language models, generative AI, into their existing workflows. They are mission critical in the AI supply chain.
Okay, so that brings us right back to the puzzle. The fundamentals are a screaming success.
They really are.
Palantir's Q3 performance was exceptional. Beat on the top line, beat on the bottom line.
Revenue surged 63% to $1.1 billion. And get this, that was their 9th straight quarter of accelerating growth.
9th straight. And non-GAAP net income jumped 110%. They even raised their 2025 guidance.
Projecting a 53% revenue increase. By every traditional metric, it is a growth juggernaut.
So what is the flaw? Where is the problem?
The flaw isn't in their business, it's not in the execution, it's in the price. This is purely a story about a valuation crisis.
Okay.
The hedge funds aren't selling Palantir because they think the company is going to fail. They're selling because, at its current price tag, getting any more significant returns is almost impossible.
Even if they keep performing this well.
Even then. And this bearish view, it's not just Millennium and D.E. Shaw.
Right. The sources also point out that Michael Burry of the Big Short fame has gotten involved.
He has. And in a big way. Burry recently disclosed that he has allocated 2/3 of his entire $1.4 billion portfolio to Palantir put options.
2/3 of his entire fund.
That is a monumental bet that the stock price is going to fall, and fall dramatically. That kind of conviction from him should make anyone pause.
Okay, so let's get to the number. The one metric that explains why all this smart money is running for the exits.
It's the valuation multiple. Palantir is trading at 102 times sales.
102 times sales. Let's just let that sink in.
We really need to put that number in context. The source material describes it as the most expensive multiple in the entire S&P 500.
The entire index.
By a wide margin. I mean, if you look at the next closest company, that's AppLovin, which is a leader in ad tech.
And what's their multiple?
They trade at 32 times sales, so Palantir is over 3 times more expensive than the next priciest stock in the whole index.
That is genuinely alarming. I mean, how does any company possibly sustain that? To de-risk that multiple, Palantir would need to, maintain 60% growth for years and years?
Precisely. With zero mistakes, no economic slowdowns, no market shifts. It's priced for absolute perfection indefinitely.
We've seen this before, haven't we?
We have. We saw similar multiples during the dot-com bubble and then again with some software and genomics stocks in 2021. And what happens next is almost always the same.
The fall.
When that growth slows, even a little bit, say it drops from 60% down to 40%, the stock doesn't just pull back. It often experiences a catastrophic repricing. I'm talking drops of 70% or more.
Because the market has already priced in the absolute best-case scenario.
Exactly. It leaves these funds exposed to the maximum possible downside risk.
And the sources point to one other thing, a detail about the insiders.
Yes. The CEO, Alex Karp, has sold over $2 billion worth of his own stock in the past couple of years.
$2 billion?
Even while he was publicly accusing short sellers like Burry of manipulation.
Wow. When the person running the company is selling that much of their own stock, that's a huge red flag.
It is. So the hedge funds basically looked at all this and concluded, great AI company, but the valuation is a historical anomaly. It's unsustainable. Time to go find opportunities somewhere else.
Okay, so that makes perfect sense. We get why they ran from that level of risk. Yeah. Now let's pivot. Let's see what Circle Internet Group offers that's so compelling.
Right. What are they buying instead?
First, the specifics of the investment. D.E. Shaw started a brand new position, right?
New position of 33,100 shares. And Millennium, they increased their existing stake by 3%. Now, these are still small positions for funds this size.
Sure.
But the directional trade, that's the signal we have to analyze.
And we should probably clarify Circle's status here. It's not a typical IPO you can just buy on the stock market yet.
That's a critical distinction, yes. They were preparing for a direct listing. So the investments we're talking about were likely made in the private market or through other instruments ahead of that public debut.
So these funds are getting in early?
They are positioning themselves now. Circle's core business is issuing stablecoins. Specifically EURC, which is pegged to the euro, and the much, much larger USDC, pegged to the US dollar.
We hear a lot about stablecoins. USDC is number 2 overall, just behind Tether. So why is Circle, specifically USDC, so much more attractive to these huge regulated funds?
It boils down entirely to 2 things. Institutional trust and compliance.
Okay.
That is the single biggest differentiator. For instance, analysts at JPMorgan Chase have pointed out that USDC's transparent reserve management.
Meaning they prove they have the assets to back up every coin.
Exactly. They regularly audit and publish exactly what assets are backing every single coin.
Yeah.
That makes it far more trustworthy for regulated entities than, say, Tether.
So it's the quality of the backing and the regulatory framework around it.
You got it. And that leads us to this really critical piece of European legislation, the Markets in Crypto Assets Regulation, or MiCA. Circle's proactive compliance with MiCA sets it completely apart from the competition. This regulatory stamp of approval is like a golden ticket for them.
And why does that matter so much to a hedge fund?
Because MiCA doesn't just grant some vague sense of trust. It literally opens the door for sovereign wealth funds, pension funds, huge asset managers.
The really big money.
The biggest money. And those institutions, by their own mandates, cannot touch unregulated crypto products. By being compliant, Circle is positioning USDC to be the preferred, safe, regulated highway for traditional finance.
While their competitors are still kind of stuck outside that institutional ecosystem.
The funds are betting that the future of massive capital flows depends on regulation, not on avoiding it.
That's a very compelling argument. But they're not just sitting on a stablecoin, are they? They've also launched the Circle Payments Network.
They have back in May, and this is where you see the real-world utility starting to kick in. This network uses blockchain to make transactions faster and cheaper.
For things like supply chain payments, retail, payroll.
All of the above.
But hang on a second. A payments network. I mean, we already have Visa, MasterCard, Swift, a dozen others. How is a blockchain solution fundamentally better than what these giants already offer?
That is a great question. And the answer is really about scale and cost, especially for cross-border B2B transactions.
Okay.
Traditional international payments often use these old, antiquated systems like correspondent banking. They're slow, they're opaque, they're expensive.
We've all been there.
Right. Circle's network uses USDC on-chain, which allows for near instantaneous settlement for a fraction of the cost. They are basically selling a replacement for the world's old financial plumbing.
And are people buying it?
The adoption numbers look really promising. They've already enrolled 29 financial institutions, and they have another 500 interested parties in the pipeline. That's rapid buy-in.
Okay, so let's connect all these dots. Let's compare the growth potential for Palantir versus Circle. We need to look at the sheer size of the market Circle is playing in.
We do, and we need to talk about scale here. The global stablecoin market is currently valued at around $310 billion.
And Circle's coins make up about a quarter of that.
Roughly, yes. But it's the future estimates for this market that are just staggering.
Go on.
I mean, they vary, but they all point to exponential growth. Analysts at Seaport Research project the market could hit $2 trillion.
$2 trillion.
And Bernstein forecasts a potential market size of $4 trillion within the next decade.
$4 trillion. If that happens, that's a potential increase of, what, 12-fold?
Yeah.
That kind of growth implies a massive shift of global commerce onto these rails.
It does. And Circle itself is predicting their USDC volume will grow by 40% annually. They are right in the path of this huge shift of real-world assets onto regulated blockchain infrastructure.
And this brings us to the ultimate contrast, the aha moment, the valuation advantage that really explains this entire hedge fund pivot.
Look at the trade-off. On one hand, you have Palantir trading at 102 times sales. Hugely expensive, price for perfection, massive risk if that growth story falters even a tiny bit.
And on the other hand,
You have Circle. Factoring in its growth, it's trading at just 6.5 times sales. 6.5. That is remarkably reasonable for a company with a consensus forecast of 33% annual revenue growth through 2027.
backed by a market that could grow by 12 times. The hedge funds are swapping extreme valuation risk for high growth potential at what looks like a deep discount.
The risk-reward ratio is completely inverted. And the analysts covering the company seem to agree that it's deeply undervalued at its current private price, which is around $69 a share.
The price targets certainly reflect that optimism. Citigroup has a target of $243. That's a 250% upside.
Canaccord Genuity went even higher.
They did at $247.
And Seaport Research was the most aggressive of all, with a target of $280. That implies a potential 305% upside.
Those numbers are all built on the idea that this regulated, compliant infrastructure is the future. The hedge funds are swapping the excitement of a very pricey AI sector for what they see as a foundational, necessary infrastructure play for the next decade.
They want to own the rails of global finance, not just the apps running on top of them.
That's the bet. This has been a really fascinating deep dive. The core lesson here from Q3 seems to be that these major funds, Millennium and D.E. they're choosing valuation safety and regulated institutional crypto exposure
Through a compliant giant like Circle.
over the rapid but just unsustainably priced growth of a leading AI company.
And based on that compelling valuation and the massive projected growth of the market, our sources have a pretty clear takeaway. If you're an investor with a time horizon of at least 3 years.
And crucially, if you can get access to instruments related to its upcoming public listing.
Yes. Then they strongly suggest considering a small position in Circle to capture that infrastructure growth at a really reasonable price.
And we'll leave you with this final provocative thought. It links right back to the sophisticated bet these funds are making. They are clearly betting that regulation will favor compliant giants like Circle. MiCA compliance is their key edge. So if stablecoin regulation accelerates globally, does that institutional stamp of approval cement Circle's dominance, basically giving them a monopoly on the regulated financial highway? Or does all that regulatory clarity just invite new, unexpected, deep-pocketed competition that could limit that predicted 12-fold market growth?
Something to mull over as you watch these traditional financial whales wade into the future of money.